Hey there, and welcome back to the channel. My name is Krystal CPA with LYFE Accounting, where we help you to save on taxes and build your wealth. Today, I want to help you do just that by going over 10 self-employment tax deductions that will lower your taxable income and, of course, your tax bill. If you are self-employed, meaning you own your own business or a freelancer, or pretty much if you own a business rather than working as an employee in someone else's business, you are considered self-employed. And fortunately for you, the IRS favors self-employed individuals and offers them some tax deductions to incentivize them to continue to be self-employed. So if you want to learn more about self-employment tax deductions and how to use them to your utmost advantage, then please make sure to stick around until the very end of this video for some very useful tax information. And hey, be sure to like and subscribe if you don't want to miss out on more tax-saving strategies. All right, the very first self-employment tax deduction is the self-employment tax deduction. You might be wondering, what do you mean? Well, if you're self-employed and you earn a profit during the year, you are going to owe what is called self-employment tax. Self-employment tax is made up of Social Security and Medicare taxes. When you are self-employed, you have to pay both the employer and employee portions, which comes up to be about 15.3% of your net profits. But there is a self-employment tax deduction for the employer portion you pay, which ends up being about 50% of what you pay in self-employment taxes. So for example, if you paid $15,000 in SE tax, you can and should write off 50% of that, or $7,500. You take the deduction on Schedule SE and attach the schedule to your annual tax return. The second self-employment tax deduction is retirement contributions. Everyone, and I mean everyone, should be saving for retirement if they can. And if you are, as a self-employed individual, this means some tax savings. Specifically, when you make contributions to a SEP IRA or simple IRA retirement account, you are able to deduct those contributions in the year you made them up until your filing deadline. So you can still make contributions to these accounts up until April 15th and use those deductions on your tax return when you file this year. But not only are your contributions tax deductible, they are also tax deferred. Meaning, as your retirement account grows and earns interest, you won't owe any taxes on that until you retire and start taking money out. And for a lot of people, they're actually going to be in a lower tax bracket at retirement, so it makes even more sense to pay taxes then than now. Just be mindful that there may be some income or contribution limits that you should adhere to in order to take full tax advantage of these write-offs. The third self-employment tax deduction is health insurance premiums. When you work for someone else, sometimes you have the option for signing up for their employer-sponsored plan. But of course, when you are self-employed, this responsibility is solely on you. Fortunately, you are able to deduct 100% of your monthly health insurance premiums for yourself, as well as for your spouse and your dependents on Schedule 1, Line 17 of Form 1040. There is one major exception to the deduction, and that is if you or your spouse were eligible to participate in an employer health plan, then you would not qualify for this deduction. And of course, your business has to have earned income during the year to qualify for this deduction as well. The fourth self-employment tax deduction is vehicle expense deductions. If you use your vehicle for any business purpose, whether that be for meeting with customers or driving to the post office to mail shipments, then this deduction is for you. Even if you use your vehicle for business and personal use, you can still write off the business use of your vehicle. And there are actually two ways you can do it. The first is the standard mileage deduction. For this method, you need to keep track of your business miles during the year and then apply the standard mileage rate to it. The standard mileage rate changes pretty much every year, but for 2022, it is 58.5 cents per mile. So you multiply your business miles by the standard mileage rate, and that is your vehicle expense deduction. The second method is the actual expense method. For this method, you keep track of all of the money you spent on the operation of your vehicle, such as gas, maintenance, tires, insurance, etc. Then you figure out how much of your miles were for business. So if 80% of your total car miles were for business purposes, you would deduct 80% of your vehicle's actual expenses. Now, depending on your situation, one method might result in a higher tax deduction, and that should be the one you apply. Use Schedule C to report your vehicle expenses. The fifth self-employment tax deduction is business meals. This deduction used to go hand in hand with entertainment, but has since been separated into its own category. But basically, if you are talking business over a meal with a client, potential client, business partner, vendor, or employee, you are able to deduct 50% of the cost of that meal, as long as the meal is not considered lavish or extravagant. However, as a temporary exception, starting on January 1, 2021 through December 31st, 2022, business meals can be considered 100% deductible if eaten at a restaurant or bar. Just remember, you can't deduct meals for personal reasons, and the increased meal deduction does not apply to food bought at a grocery store or convenience store. All right, we are halfway through here. Let me know in the comments if this video has been at all helpful for you. I'd love to hear from you. The sixth self-employment tax deduction is the home office deduction. I personally love deductions like the home office deduction for self-employed individuals because they are deductions that are normally considered personal if you were an employee, but with a business spin added to it can result in significant tax savings for expenses you're going to have anyway. Now, with the home office deduction, you need to have a dedicated workspace in your home that is solely used for business. If you do have that, you can write off a portion of your rent, mortgage interest, utilities, repairs, insurance as a business expense. To do this, you would divide your home workspace by the total square footage of your home and apply that rate to the applicable expenses. For example, if your home office takes up 15% of your home, you can deduct 15% of your home expenses as a self-employment tax deduction. And you would use Form 8829 to claim these expenses and attach it to your annual tax return. The seventh self-employment tax deduction is the rental use of your home, or the Augusta strategy. This is an advanced one, but I promise it's not that hard to use. But essentially, you're able to rent out your home to your business for up to 14 days during the year. The rental rate you charge your business should be on par with other rental rates for similar properties in your area, and your business is able to deduct those rental expenses from its income. Even better, the rental income you receive for renting your home to your business is considered non-taxable. And how many times do you hear income as non-taxable? Not very much, but it is in this case. This is a great way to get paid from your business tax-free while also getting a business tax deduction. It's a win-win. Make sure to use Schedule C to write off the rental expense. The eighth self-employment tax deduction is cell phone expenses. Well, of course you use your cell phone for business, right? Perfect. So if you do, you can not only write off the purchase of the cell phone, which, let's be honest, is over $1,000 these days, but you can also write off the monthly service for it. But similar to the home office deduction, you can only write off the business use of your cell phone. So if 60% of the usage of your cell phone is for business purposes, you can only write off 60% of the cell phone and monthly service on your tax return. It would be good to keep track of your business calls to figure this out. The ninth tax deduction is travel expenses. Perhaps you need to go to Hawaii, right, to scope out some potential real estate investments. Well, the flight, lodging, transportation, and even food would all be deductible. If, of course, the sole purpose of the trip is for business. You can mix personal and business trips together, but there should be a clear distinction on which days were for business and which days were for personal. And that way, only the business days are considered and deducted. Again, these expenses can be written off on Schedule C. The 10th and final self-employment tax deduction is interest expense. If you've taken out a business loan or business credit card, then you know a big part of what you have to pay back is interest. The IRS doesn't allow you to deduct the principal payments, but they do allow you to deduct the interest portion of your loans, which for some credit cards can be as high as 20%. The important thing here is that your bookkeeping properly allocates your loan payments as principal and interest, so it is easy to see what was paid in just interest for the year. And just make sure to report this amount on Schedule C, line 16. Now, which one of these self-employment tax deductions will you use this year? Let me know in the comments, and I'll see you in another video.